Thank you everyone for joining our webinar. We're honored here to have Adrian presenting the top 3 benefits of investing in real estate syndications versus stocks. This is our second webinar that we posted on our platform. So we're super excited to get everyone more engaged on the platform and to make more connections happen. So we'll turn it over to you, Adrian, to present, and we'll save a little bit of time afterwards for our Q&A. Adrian, take it away.
All right. Hi, thanks, Christina. It's a pleasure to be here tonight. Thank you all for taking the time out of your evening. I know it's a end of day of work. At least you can just sit back and relax, and I'll share and provide as much value as I can. So I'll go ahead and start sharing my screen. Christina, are you seeing the?
Yes, we're good.
All right, gotcha. All right, so tonight we'll be talking about the top 3 benefits of real estate syndication over stocks. Now, this is a hot topic because in the space of investing per se, real estate and stocks is like the 2 most important topics. But particularly this one tonight, we'll be covering syndications, and it is probably one of the not so familiar areas, at least in real estate, that people invest in. So no, not to worry, if this is your first time hearing about it, we will do a quick touch over definition of how real estate syndication works. My goal here is like if you walk away here tonight and knowing something that you didn't, and then our objectives are met, right? So let's start off with a little bit about myself. My name is Adrian Fajardo. I'm a general partner or a sponsor. Don't worry if you don't understand what those terms mean. I'll cover it later in the presentation. I'm also the marketing manager for Cashflow Portal. I've also served in the United States Army as an officer. I served for 6 years, and I've passively invested in 2 deals totaling with 61 units, and I own 2 multifamilies here in the Killeen area. So this is what we'll be covering this evening. And I'll give you a chance to read what are the agendas tonight. And while you do that, let me put out the housekeeping rules, which is there's really just one. Please hold all your questions up until the end of the presentations. Don't worry, I'll go through as smoothly and as swiftly as I can without sacrificing your understanding. That means I'll give you enough time to actually ask your questions, and I do want to address any of your questions. And that said, just write them down, and you can always come back to a slide that you want to clarify. Okay. All right, so let's address the first, the elephant in the room. So most of us really heard of real estate and how to invest in it, like buy and hold and flipping, but real estate syndication is something that is new to most people. But really the word that I will try to explain here is syndication or syndicate, because it is a form of investing that can be done in multiple industries, and it just so happens to be applied in real estate. So according to Investopedia, syndicate is a temporary alliance of businesses that joins together to manage a large transaction which would be difficult or impossible to effect individually. So simply put, it's a partnership, right? Because what we're trying to take down requires a lot of capital. So it's not really feasible for 1 or 2 people to have enough money to take down a property. So what happens is they needed to create a partnership or bring in more people to pool more capital to take in an asset, which is, in our case, an apartment building, a large apartment building. Okay. So I mentioned partnerships. There are really 2 sides of the partnership. It's called the general partner and limited partner. The general partner, as I mentioned in my introduction, is also known as a sponsor. They're interchangeable terms. And the easiest distinction between a general partner and a limited partner is that the general partner is an active investor, while the limited partner is the passive investor. And tonight, the benefits that we'll be covering is specifically geared for the limited partner. And I will be going over the 3 benefits in the next couple of slides. But if you want to learn more about syndication, I highly recommend checking out this resource. So if you scroll down and search apartment syndication in YouTube explain, if you scroll down, I would highly recommend you check out this guy. Yeah, he kind of looks like he knows what he's doing. No, but seriously, this is a great resource. I did a thorough explanation of what apartment syndication is all about, and I also want to recommend this one, the second one. Very easy explanation, and it's also very thorough as well. Okay, so let's move on. Let's start with benefit number one, better returns. Okay, so earlier we talked about the two parties involved in real estate syndication. So particularly on the limited partner, how does the limited partner make money? So I would like to share the most simplest form of real estate investing, or one of the most popular. It's called house flipping, where you buy a distressed property, you fix it up, and then now you sell it for a profit because you bought it at a discount. In most flips, the person who is buying doesn't really have the capital to rehab and purchase the property. He has the skills, or he or she has the skills to, fix it up and make it look nice, but they don't have the capital to purchase and rehab at the same time. So what they do is they search for a capital partner, someone who has the money. Now, the person who has the money is the counterpart. Well, they may be high earners, they have a good paying job, but they don't have the time or resources to actually flip a property. So they partner with this flipper. And so what they do is they come together, they take down the property, and then after they sell, they split the profits 50-50, or however they arrange it. Now, syndication is exactly the same way, or almost the same way, the concept, but the timeline is longer and there's just more zeros in the number, right? So the three general ways how a limited partner makes money is through cash flow, proceeds from the sale or refinance, and tax advantages. So I'll go over each one of this in detail. Okay, so since we're comparing it with stocks, right? Like this is one of the benefits, which is real estate is better, I think is better than stock, or I know it's better than stock because of this one here in particular. And then the terms are really identical, as you can see. Cash flow in stocks is really just dividends, and proceeds from sale really is also from the sale in stock. And each of them has tax advantages, although in real estate there's just way more advantage. So first, let's go over what are the historical returns of each of those categories. Now, I pulled this from statistical data, which we'll cover later on. But on this slide, let's first focus on cash flow. So it says here real estate is typically between 7 to 11%, and an index or stocks is between 1.9% to 4.3%. All right, so if you look at this slide, this is pulled from Investopedia. This is the S&P 500 dividend yield, not the value of the S&P 500, but the dividend that it pushed out all through the years since 1871. Excuse me. As you can see, the highest it's been, our great year was 4.03 in 1970s and 1990s, and it averaged out right now in 2009 to 2019 at 1.97%. And on this slide, it shows you the trend, right? There's those red points are the down years, or at least the lowest point it's ever been. So that's Black Tuesday, Black Monday. This is the dot-com bubble when it burst. And obviously on this dip here, we all know what happened in 2020. Okay, so next. So let's do a simple math. Before that, let me show you a sample return for real estate. Now I'll take you over now to our site, which is on that video that you saw, was cash flow marketplace. So this is the marketplace where actually you can see live deals going on. So let me choose one of them. And yes, this is actually real deals that they're raising capital for. So I'll pick this one property. Okay, so I want to go down here to the two different offerings. I want you also to focus on this Class B. says equity and cash flow. Particularly this line here, minimum of 50,000 and average cash on cash return or cash flow. It's saying it is a baseline of 6.8% or higher. Okay, so let's remember that number 50,000 and close to like 7%. Okay, so in real estate, if you invested 50,000 in that deal, on average, if you get a return on 7%, that is 3.5 per 3,500 per year. So I just multiply 0.07 times 50,000, that gets me 3,500 per year. So the question is, for stocks, how much do you have to invest in a particular stock to get 3,500 per year in dividends? Okay, so to put that in context, I pulled in a stock quote, and we're all familiar with this company. It's Apple. I know it's kind of confusing, but I want you to focus on this number here in the lower right-hand corner. It's called the trailing dividend yield. This is what Apple has pushed out as dividends previously, and you can see the forward dividend is 0.59%. But let's use the 0.58%. Let's go back on our slides. So let's add that number. What is the capital needed on a 0.58% yield to cash flow 3,500 per year? And the formula is simple. Just divide the cash flow, which is 3,500 per year, divided by 0.0058. That gets you 603,448,000. That's what you have to invest in Apple to get the same 3,500 per year. And mind you, that is 12 times the capital you invested in real estate. So moving on. So that we covered cash flow. Now let's move into sale. Now this return is what gets investors really excited, because cash flow, yes, it's fine and all, but the sale of anything like capturing equity is what actually builds wealth. And this is my saying, or my belief, is that cash flow can help you sustain a lifestyle, but equity can change a lifestyle. True wealth is really built through equity. So this criteria is what gets most investors excited. As you can see, 12 to 25%, and in stock it's typically 7 to 9%. So I will pull up next the VFIAX ticker symbol. This is the Vanguard 500 Index Fund, the Admiral funds. Now, if for those who are not familiar with an index fund is, it really just mimics a current index, right? So the index it's basing out of right now is the S&P 500. So if you can see there in the bottom right here, VFIX and the benchmark, that benchmark is referring to the S&P 500. So as you can see, it's pretty close. It deviates a little bit, 0.89 there, 0.03% there. But what I want you to focus is this number. It's average annual return since its inception in the year 2000. And then if we will go back to the sample deal that we used, because I use annual average return is because that metric is present in both stocks and real estate, and it's actually very easy to calculate. So if you look at the same deal, right here, it is the annual average return is plus 20%. Now, if you just do a quick calculation, if you invested 50,000 and then what you're averaging is 20%, that's 10,000 per year, and obviously that includes the 3,500 of the cash and cash. So your cash flow plus the equity or the proceeds from sale, if you combine it and spread it across the 5-year hold period of this deal, it is averaging 20%. So that's pretty significant, and that is a return on your investment, not really of your investment. Okay, so let's move on. So that covers, we're pretty much done with benefit number 1. Now let's move on to benefit number 2, and this one really is the biggest, that is not taking advantage of, And quick disclaimer before I get started, I'm not a CPA. This is only for educational purposes. I do recommend you still speak to your CPA. But yeah, this is a very underrated benefit because a mentor of mine once told me that it's not really how much you make, but it's how much you keep, right? And because an increase of income has a corresponding increase of expense. Like if you buy more, a nicer equipment, there's an added cost to it, like the more repairs, the maintenance. But a dollar saved is actually a dollar straight to your pocket. So there's no associated expense that increases with it. So keeping more of your money is definitely a very underrated aspect in investing. So let me share with you first the couple benefits you get from real estate syndication. And the first one is depreciation. This is a very magical concept. So the way Congress made in the tax law is that a building is losing its structure, like it's degrading as time goes by. So they write it out as a loss, so you can claim it on your taxes. So for residential, that useful life of a house is 27.5 years, while for everything else, it's 39 years. And if you do a quick math, 1 out of 39 years is a 2.6% write-off of the value of the property. So basically, it's this. The higher the depreciation, the lower your taxable income, therefore, the lower your tax bill. So let's move forward with cost segregation. I wanted to cover these two first, and then I'll show you a quick example. Cost segregation is just like depreciation, but it is catered to the items inside the building. Because when you buy a building, it doesn't just come with the structure. It has carpet, it has hardwood, it has cabinetry, it has the faucets, the toilets. All those too are losing value. And in order to do this, you actually have to hire a third-party expert. They do what we call a cost segregation analysis study. And then they give you the report, and then you file the report with the taxes, because they're engineers that breaks down the useful life of those items because they degrade differently. So let's go back over the example deal, and I want to show you this one. So it's another deal, and over his offering, you see here in the bottom, he says great bonus depreciation estimated at 90% of investors' contribution for 2022. So the reason why it's very hard to calculate cost segregation and totaling that with depreciation is because no two buildings and apartments are going to be the same. A lot of them are built differently. Even if they're built in the same year, they may be built with the same structure, but maybe there's two floors, 3 floors, garden style, spread out. And the materials they use inside, like maybe it's nicer furnishing, marble. So the tax advantages is different, but this investor states that it's a possibility of 90% of the contribution they invested with. Okay, so let's head back to the slide and go to the next one. Mortgage interest write-off, that's an easy one. This is the same as your for those who own their homes, so you can write off the interest of your loan. And the last one is the 1031 exchange. This is to forego your capital gains tax once you sell the property. That means if I bought a property and increased in value by about $1 million, if I sell it, I will have to pay taxes on that $1 million capital gains. But if I use that entire proceeds to buy another property, I can actually use that full proceeds that I got from selling the property and move it to a different assets. Now, I will cover this on tax and stocks, but in stocks, if you buy, or let's say you bought a stock worth $10,000 and that same stock grew to 1 million or 10 million. Imagine the capital gains tax you have to pay once you recapture the value of those stocks. Right? There's no way to forego those taxes. You have to pay them once you sell. So this is a quick side-by-side analogy of the tax benefits of both, right? We already covered real estate. For stocks and indexes, so long-term capital gains is if you held a stock or an index for more than a year and then you sell it, you still have to pay taxes but at a lower rate, the lower capital gains tax. And then the other tax advantage is those if you bought and sold stocks in tax advantage accounts, which is the Roth IRA, 401k, and TSP. So just a quick cover on each of them. The difference is Roth is after tax dollars. So you've already paid the taxes, you've put money in that account, and it's growing tax free. And the moment you pull it out, you won't pay taxes for it anymore. But for 2022, the max contribution for a Roth IRA is $6,000. Now moving on to TSP and 401k. So they're essentially the same thing. Your employers can match your contributions, but you're choosing out of the pool of investments that your employers choose for you. So I mean, there's still options, but it is now narrowed down to their preferences. The difference between TSP and 401k is that you're putting it in pre-tax. So it's growing tax-free, but the moment you pull it out, when you start your withdrawals, you will be taxed at that tax bracket that that time when you start withdrawing your contributions. And for TSP and 401k in 2022, it's capped at $20,500. So it's far less than the $50,000 on that real estate that you can. That was the minimum. So I will use TSP for example so you can see the returns that you're getting. And this is for my friends in the service and all of the federal government. So these are the funds that's capable available for you to choose, right? The C, F, G fund, and the most popular one I think would be the C fund, which is as you already saw, that tracks or mimics the S&P 500 index. And I'll share with you this chart again. Remember that same fund. So if you've composed your TSP with the C fund, it is growing on average at that 7.8%. So that covers the second benefit. Now we're down to the third benefit, which is risk-adjusted returns. I myself have learned this recently because I really didn't know how to gauge investment. I always just thought that, okay, the most money can make, I'm all for it. But at what cost? Like how risky it is to gain that certain kind of investment. Because the old adage is that, yes, higher the risk, higher the rewards. So you really have to gauge your risk tolerance. But simply put, in an ideal world, you want the highest returns with the lowest amount of risk. And apartments has that very nice sweet spot, and I'll tell you why. So why is it less risky? First of all, it's a tangible asset. That means it's something you can touch. It's a physical structure. That means you're able to manipulate. You can able to control it. Also, it has a use, which is it's a big use. It's one of the basic needs of man, right? Outside of food, water, and air, it's actually one of the needs that is for survival. And if you look back in the day on how stocks were, so you go to a brokerage, you say, I want X amount of shares for the stock. They write you a piece of paper that says, you bought it for this. This is how much of shares you have. And that is what you get. It's a piece of paper. Now that piece of paper has an potential value depending on how much value that has it increased, but you can only recapture it once you trade that paper. But while you're still holding a paper, it really is just a paper, right? But in real estate, yes, we're like I've said before, equity is what makes wealth. But while we're waiting to get to that wealth, there are people who have made use of that building, which is they live on it. So there's a very, very big use for it. And in this generation, apartments are actually becoming the more preferred choice of housing. COVID has taught us how to live or not confine us to one location. So more and more generations are trying to say, like, listen, I might want to live here 1-2 years and I want to explore another place. So I will actually show you a chart that explains that. So the red line right here is the amount of or the measure of home ownership in the United States, while the blue line is the vacancy rates. So as you can see that there is a sort of like tandem beginning even from 2002 all the way up to 2019 or so, right? So what this means is that fewer and fewer people are owning homes. And if you see that spike, that gray line and that spike where the red line goes on top, well, if homes are incredibly cheap, people are smart as well. So if I'm paying this for rent and it's I can use that to buy a home, might as well buy a home. But prior to that, the trend is actually coinciding that more and more people are moving to rents because the vacancy is going down. So moving forward, more control. So the reason being is that let's say when you buy a stock, you're actually a part owner of the company. But how often do you really get to the boardroom? And even if you do get to the boardroom of those companies, how often do you really have a say on the business plan? And it's odd because yes, as a limited partner in the partnership with general partner, they do not get to get a say, but the business plan is so simple that it's a concept that's being used over and over again. So it's very easy to explain where the value is going to come from after we change operations. Do you guys remember the time where Amazon released the Curve phone? Well, they spent millions and millions of dollars of it, but where is the second version of that? So it's a failed project that they didn't pursue. So it's things like that. Like when these, even like the most valuable companies in the world, when they have a product, it's really not a proven concept. It's like a guess. So you really don't know if they release it, if the public will want to get it or not. And that is what I meant by risk and control. And lastly, it's predictability. So why do I say there is more predictability in real estate? Well, that's simple, because our stream of income is on a contract, which we call a lease. So we actually know how much tenants are paying and how long they'll pay it for. And then it's actually stated in the contract that if it's month to month, 1 years, and that's why real estate really is a lag, because we're waiting for leases to cycle over, for people to not renew, or we can make changes in the deal. But yeah, that covers predictability. Yeah. So outside of that, let's speaking of predictability, let's look at the S&P 500 now. I took the snapshot just a couple of days ago, September 2nd. So as you can see where it's trending. Here, let me help you out. See that its high was lower than its previous high. So you can see that downward trend up until August. So this is from January 2022. Now, let me show you just two correlations with that. Next. So we have already see the trend. So this is the rental vacancy rate in the United States from Q1 of 2012 leading up to Q1 of 2022. So that is downward, same thing, downward trend in the rental rates. But I also want to share you this interesting trend right here. So everything in gray, you see these gray bars here, these vertical gray bars, those are the downturns in our economy. So 1990s, it was the credit and loan crisis. In 2000, we all know what happened with the dot-com bubble. 2008 was the great financial crisis. But Adrian, that was caused by real estate. No, it wasn't. It was the problems in Wall Street, and it overflowed to Main Street, right? That was because of the collateralized debt obligations, the derivatives, credit default swaps, subprime mortgages. All of those were because of those financial banks, those big financial banks. So moving on, obviously we know what happened in 2020, that's COVID. So as you can see, this is rents in the United States in relation to all those downturns. So you see how even during the downturns, the worst times in our economy, rents are still increasing more and more because, as I've said, it is one of the basic human needs where there will always be a need for it. Like people will probably cut their subscription in Netflix, Disney Plus, maybe even their phone line, but having a roof over your head is one of the biggest ones. So that's an interesting fact. And yeah, so in summary, this is what we've covered this evening. I describe what a real estate syndication is, and it really is a partnership. And the partnership is composed with the general partner and the limited partner, which is the active and the passive. And then this is the meat and potatoes of this presentation, which is the three benefits real estate have, and in also comparison to stocks and what they have in common. So yeah, what are your questions? Not all at once, please.
I can start off with a question. So in terms of, you mentioned that in one of the slides, in recessions or any downturn in the economy, there's always been a steady increase in rents. So I
Yes.
guess, in what cases or what circumstances have you heard of in terms of investing in a deal and then actually losing money? I know it's very rare that it happens, but in terms of it, apartment syndications being very recession proof, can you talk a little bit more about that?
Yeah, a great question. So I always fall back to the law of supply and demand, right? What typically happens is maybe in a recession or a downturn, like a high unemployment rate and all that. So the biggest ones that will take a hit first is the A-class properties, because those who, and for those who are not familiar, A-class are those really luxury kind of apartments. Like they're smack in the middle of the city center where you go downstairs out of your apartment, immediately there are nice restaurants, nice walking parks, dog parks here and there. They would be the first ones to take a hit because the people going to those communities goes there because of the amenities, right? And during a rough time, like I said, the first things that will go is our luxuries, our entertainment. So they might say like, I could probably go to a B class neighborhood. That means it's kind of safe, It may be it's a little bit of a drive to those nicer end, but I still have access to it. But this is nice. It's clean. It's safe. So vacancies for those apartments will take a hit, and then now Bs will be like, that's where people would tend to congregate with. But those people in the Bs who also think that the B was their A will now move into a C. So the first things that will happen really is a shift of occupancy. Now, I did not say no one will be in apartments now. They'll still need a place to live, but then their expectations will change because now they'll do this cost cutting and do what is a necessity. I just need a roof over my head, so I'll move on to those assets. So as an investor, I have to be keen on the market cycle and my strategies on my exit, right? The beautiful thing about real estate is that our finish line is the sale or the refinance of the property, and us cash flowing is our lifeline for that. So my mentor taught me that if you have a good, let's say an 8% cash on cash every year, that is also your buffer, because if you have that 8% gap between you paying out people and breaking even if it's 2% cash on cash, you're still paying the bank. And that is the great thing, because the bank can't repossess a property that you're paying. Your investors might not be happy, but you can say like, hey, we still have the asset. We can still ride this out and make it to that sale. That's why cash flow is important, because controlling cash flow is your lifeline up until you hit that finish line. So those are the two things that I guess you could consider as a real estate investor, right? The asset class, where you are in the market cycle, and what is your strategy.
Thank you, Adrian. We'd love to open it up to the audience to see if there are any additional questions. Otherwise, I can continue. I think this presentation is very fascinating.
Hey, Adrian, I got a question.
Yeah.
Hey, great presentation, by the way, so far. It's just great. It's really keeps it simple in English. Can you give us a sense of like all the benefits you mentioned? Most of the information you provided was talking about like when you're talking about cash and cash return as it relates to the stock market. But I'd love to hear more about like how would you describe what the benefit of like depreciation looks like? I know you can't give a hard percentage. Every tax rate is different. I get it, but like, how can you give us a sense of how that can be considered along with a cash and cash return?
Yes, yes. And Steve, just to clarify this, remember this is for the limited partners. So depending on how much they put in, so let's say $50,000, right? And then part of depreciation cost segregation is 90% of that. So when you file your tax, which is the general partners gives you a K1 saying this is the value of your losses for the year, and then they bump it back on your taxable income. So there is a huge more often the times not where it actually wipes out your taxable income and you get money back. I know I can't really put a dollar amount of it because I can't understand if people have a what are their taxes, and people are different. Like some states tax you differently if you have kids, or some states doesn't have those kinds of benefits. But for example, I've known a couple very successful syndicators. They probably own thousands of units, and I had a meetup with them, and they said we have not paid taxes in the past. I think they said 4 years now. Not that they don't pass, but they own enough properties that it offsets all their income. So yes, I hope that answers your question, Steve.
No, it does. It does. I think what's often misunderstood is, yes, you can gain value in your returns, but a lot of wealth comes from keeping your money, right? Or not as much as earning money. And I think the cost segregation topic is like really important.
Yeah, and to your point too, because it is after the fact, and people really do not really appreciate tax returns or like offsetting your taxes, because when you get your distributions quarterly, let's say it's quarterly, so every 3 months from a syndication, right? You see that hard money coming in, but after everything is spent, and obviously your returns happens every just once in a year, it was a memory. Like you really didn't appreciate how much money that you gained or lost that year, and then how much you got back. So, but yeah, just to put into context, like if you gain something, that means it actually offsets everything else that you've spent on basically on taxes for that year.
I also think 2022 is the last year you can claim bonus, a 100% bonus depreciation. So all of the investors are like, I have to invest before the year ends and take advantage.
That's true. That is true.
I think after every year, it decreases by 20%. So 2023, the max you can claim is 80% bonus depreciation.
Mm-hmm. But simple answer, go get with your CPA. Yeah, we're not experts here, but that is basically just the bird's eye view of how that works. Oops, let me slides.
Adrian, when you made your first investment, I'm curious to know, was it scary for you in terms of wiring, X amount of dollars to this sponsorship team? I'm always curious because when I did it for the first time, I was like shaking, and I actually had my sister do the wire transfer for me. I think there's a level, yes, you can trust the sponsorship team, but there's also when you actually transfer all of the money in the wire, and also all the responsibility and trust to the team to take ownership and manage the property. It's a scary process. Can you talk about that when you made that transfer?
No, that's a very interesting question. And to be completely honest, I did not get that fear, and here's why. I can't even remember the book. It's killing me. But the way the author mentioned in the book is, you should treat your whatever money you use to invest as it can be gone. That entire sum can be gone. And if you can go to bed and sleep with that thought, then that is pure investment. Because if that portion of that money is like your savings or your emergency fund, that you have to reassess your finances. You have to set aside that kind of money for those things and not touch it, right? But really, no matter how great of an investment, even if it's a bond, the most risk-free investment vehicle out there, you have to be prepared that amount can be gone in an instant. And if you can live with that, that is actually going to train you to be a better investor. Because what really, I didn't touch on it, but what triggers that up and down really on stocks, it's really greed and fear. It's manipulated by people's opinion. And as you can see, right, we're still living the same way, but the trend in the S&P 500 is going down. Maybe investors are scared. They're just pulling their money. They want it to be liquid. So I guess I've done some sort of investments in the past that makes me feel comfortable. Like when I made that pull, I can either blame myself because no one had a gun on my head and say like, hey, send this money, right? I've reviewed it as best as I can. Yes, I know the GP. I trust them. And yeah, in the end of the day, this is what comes with investment. It's like gambling. If you're prepared to lose that money for the excitement, it's the same investment. But there's an upside. It can come back with you X amount of folds more. But that's definitely a great question, which is you have to get to a point. Maybe start out with small increments first until you get comfortable understanding that this is for the better. You've made your calculated decisions. You've done your thorough work, and it can only go so far. You can't have all the answers. There will come a point where you will not have any more answers, no matter how hard you search. You just have to take the leap and be prepared that to lose it. I'm not saying that's going to happen, but that's what I'm saying. Like, come to a understanding that if you're prepared to lose it, you'll be fine.
There's a few investors who are so like in the weeds of the underwriting. They want to know everything about how are they going to implement the business plan, and they send the first investment, and then they're like, oh my gosh, I love it. And then the next after the first investment, they're like, just take my money for the next one. I trust you. There was like no need to call or have a conversation with the sponsorship team anymore. It's just simply like, I trust you. You've done your work on the first investment I've made, so we'll continue to invest. So I think
the first trust is definitely a big factor. And that eases a lot of the frustrations, right?
Yep. I have one last question, but just wanted to give everyone another opportunity to ask any additional questions. I know Adrian spent a lot of time on this presentation, so thank you so much for that.
You're welcome.
Okay, so I guess my last question was, if anyone wants to reach out to you, connect with you, what is the best way for them to get in contact with you?
Yeah, so this is my contact information. That's my number. That's my direct number and my email. And that QR code is my digital business card. So if you scan it, that is my socials, a calendar. If you want to book a call with me, I'll be happy to answer any questions that you didn't raise in this presentation. And yeah, and also my Cashflow Portal account is in it. So don't hesitate to reach out. And the one on the right is our YouTube channel that we have with Cashflow Portal. It's a great resource. So if any of these topics are not covered, you can just hop on that site and find more of the videos that actually is pertaining to your question.
I love your videos. They're very short too. For someone who's also on a syndication journey, it makes the big concepts very digestible. So thank you very much.
No, thanks. That's like my philosophy. Just keep it simple.
Thank you.
But thanks for having me, Christina.
Of course, Adrian. Thank you everyone for joining us on a Wednesday evening. Again, you have Adrian's contact information if you want to reach out. And thank you again. I hope to see you in our next webinar. Good night, guys.